Hi, my name is Joseph-Antoine Migdilani. Today I am with Karim Zakher, who is the portfolio manager in our team. We would like to have a conversation with our clients. We have a lot of questions and we would like to be able to explain what happened during the past 3 months, where are we right now, and what are we expecting also. And first of all, I would like you, Karim, to explain a little bit about what happened and why are we here right now.
We are going through a difficult time this year. It's been a terrible year. We haven't seen a year this bad actually since, believe it or not, 1969, where a balanced portfolio, meaning a 60-40 mix, 60% equity, 40% bonds, is negative anywhere from 13 to minus 16% year to date. And usually bonds act as a refuge when we're in times of trouble. However, let's have a quick synopsis as to what's been happening. So dial back to the 2020 period, the pandemic. Governments were forced to shut down many businesses. A lot of people started working from home. It was a really tough time where the S&P 500 back in February, March, and April, I believe, it dropped about 35%. Good news after that is because of all the money printing the government did. How does the government do money printing? Well, what they need to do is create that demand for money. How do you create demand for money? You have to lower interest rates. So they really lowered interest rates virtually to zero. This is the central banks and the governments around the world, and particularly the developed economies. By lowering rates, you're creating a demand. What happened? People started buying property. When you buy a property, you buy a chalet, you tend to buy furniture.
Renovation.
You start to renovate the kitchen, the bathroom, and it created a goods economy. The purchase for goods really shot up. The purchase for services really went down. That's where we were. And inflation started to come around. We believe that it was transitory. All of a sudden, we're here today where inflation is actually getting anchored into our economy, and as a result of that, interest rates had to go up significantly. The interest rates went from 0 to over 3% in a matter of 6 months, which is tremendous.
I think we did not see this type of increase in the past before. Like, it was very significant. It was
the speed of the increase is very significant. We haven't seen it this fast, not even early 1980s when rates were at 18, 19, 20%. It wasn't this fast. This case, what happened was the central bank took too long to raise the rates. They sat on low rates for far too long. Inflation starts to get anchored, it starts to increase slowly, and now the government is kind of like panicking.
Right.
We have inflation rate that's 8%. So now they're trying to bring inflation back down to 2%, and the only way to do that is by raising rates very rapidly. So as a result, bonds in particular got hurt. In the portfolios, we have Ontario 2028 bonds that have gone down about 15% in 6 months, which is not normal. And the reason is of the rapid increase in interest rates. However, do know that even though the market value of the bonds went down, the maturity value is guaranteed by the province of Ontario.
Right.
And I just want to also clarify, all our portfolios that are managed have government bonds in them. We have no corporate bonds in our portfolios. In addition to that, if you look closely, you'll see that we own best of breed businesses. These are companies with competitive advantages, pricing advantages, and are leaders within the respective industries. So we do have good quality, but even with that, the sentiment is negative, and it drove down stock prices and bond prices quite significantly.
It did, but once again, and that's what we try to always bring up in our meeting to our clients, that the stock market can go in a rally very fast. It could go up very fast, because if we go back to June 16, the market was at his bottom, right?
Yes.
And then we saw a rally of 17%. So we saw the market increasing by 17% until August 16. So that brings the importance of staying invested, because
Correct.
if you're not invested during that period of time, you might miss the boat, right?
Right. So just to rephrase, the market hit the bottom June 16th, big rally into August 16th
Right.
of over 17%. And right now we're retesting the lows. In the month of October, we've retested the same low for the S&P 500. Now we're starting to come back a little
You
bit.
can feel that, yeah.
We may retest it a third time, nobody knows, but if you're not in the market and the market does decide to take off on a more permanent basis, you will lose out on the easy money,
Right.
which is the beginning of a rally. And a lot of people, what they tend to do is they sell out, they sit on cash, thinking they're going to get in at the perfect time, but they never do, because they're going to get in when they feel more secure. And by the time you feel more secure, the market's already up 10, 15, 20%.
Right. Right.
One last point is, in a bear market, people tend to look at their portfolio on a daily basis, and they judge the portfolio on a daily basis and make decisions based on a daily basis, when they should be focusing on a longer term time horizon, which is several years. Whether you buy a house, a small business, or even a good stock, you can't measure it on a couple of days. You need to measure it on a few years.
Absolutely. And my last question, Karim, to you would be, what are we expecting in the future?
Well, often a bad year is followed by a really good year. Of course, there's no guarantee in that, but historically speaking, when we come off a really poor year like this one, you tend to see the opposite effect a year or two down the road. And so stay invested. We feel for what's happening this year. It's a difficult year for everyone. There's nowhere to hide. If you were sitting on cash, you're no better off, because inflation's running at 8%. And even if you earn 4% on your cash and you pay half of that in taxes, you end up making a minus 6%, which is guaranteed. It's guaranteed to lose 6%. Whereas at least if you remain in the market, you have a chance to recoup all your losses very rapidly.
If you have any question, if you would like to schedule an appointment with us, feel free to give us a call, and we're going to be more than happy to sit down with you. And on another note, if you want to briefly explain about the TFSA this year.
Correct. Actually, a good side of the inflation is the fact that the TFSA contribution is going from $6,000 to $6,500 effective January 1st, 2023. And if you've never contributed to a TFSA, the cumulative contribution is now going to be $88,000 as of 2023. So that's a bit of good news. It's a great tax shelter. Everybody should use it if they have the capacity, the financial capacity to do so. I would definitely use it. And on that note, I want to say thank you so much for listening to us. If you have any questions, feel free to contact us. We're here for you. If you need a financial plan, please reach out. I want to wish you a great fall, and we'll see you soon. Bye.